Folks, if you've logged in, if you can turn your camera on, I'd appreciate it. It's easier to teach to faces than it is to gray boxes. So I'm assuming you're dressed in okay. So if you're not dressed, don't turn the camera on. You're fine. Yeah. And if you're not muted, make sure you mute yourself. Hear some music coming through. So.
Yes, sir. All right.
Go ahead. You have a question? Okay. Now, as people are getting in, because it's time, reminder that your first quiz is a week from today. Okay? It will be in the classroom, so I will send you. I'm actually setting up, make sure we have a second room so that we're all not all crowded in Paulson. And sometime towards the end of this week, I'll send you who's supposed to go to which room. It's not going to be random. It's going to be alphabetical. So you get 100 people out of Paulson. There's enough room to spread out. If you cannot come to the class physically because you're in a different country and you haven't been able to come back to the US, or because your health reasons you can't be in a physical classroom, you need to let me know. There's a Google shared spreadsheet I created for people who want to take the class online. And I need you to be on that list if you want to have access to the class. It's not to the quiz. So just let me know ahead of time if you're not going to be there. But I'd prefer you physically take the quiz in class. It is open book, open notes, not open laptops, and you can't open Excel. But if your slides are on an iPad or a laptop, you're welcome to use your iPad or laptop as the way of accessing your slides, because you might need the slides to be able to do the quiz. But any questions on the quiz before we start? Okay. 8 sessions in, we're done with discount rates. I'm not going to talk about them anymore, so that's it. So if you have any discount rate issues, you can bring them up during office hours, but we're done with discount rates. We're moving on to earnings, cash flows, growth rates, all the fun stuff in valuation, also the tricky stuff. So today we're going to talk about earnings and cash flows. And we're going to talk about a couple of issues. And as always, we're going to start with the preview with the test to kind of see how we should address these issues. It's February 23rd, 2022, right? So you sit down to value your company. You value your company as of right now. You know why you need to value it as of right now? Because you can buy at today's price or you don't buy at today's price. There's no point valuing a company as of January 1st, 2022 or January 1st, 2021. Given that your valuation has to be a current valuation, you want your numbers to be as updated as you can get them. You're saying, what does that mean? One of the key numbers you need to value a company is the earnings number for your company. What did your company make as operating income, as net income? And many of you are valuing companies where, if you look at the most recent financials, they might not be up to date, especially if you're looking at an annual report. So let's say you're valuing a company, and it's a company where the most recent annual report is from 2020. Remember, the 2021 annual report might not have come out yet for your company. So I'm going to give you some choices as to which of the reports you're going to use to value your company. And you tell me whether this is what you would do. You'd go with the most recent annual report at 10K, even if it's 2020. That's your first choice. The second is you take the most recent quarterly income and multiply by 4. The third is you add together the earnings you had in the last 4 quarters. It's called trailing 12 month. Or the fourth is you take the numbers you have so far, the 3 quarters you have, and add an estimated fourth quarter to it. In other words, you have 1 quarter of estimates and 3 quarters of actual numbers. So let's go one by one and see if it's, now what's the problem with using the most recent annual report, especially if it's 2020? It's old, right? It's 2020. Strange things happen. So take that off the list. If your most recent annual report is 2021, you're okay. One of the nice things about valuing the Fang Am stocks last week is every one of them I was able to get 2021 numbers. So they're all current numbers. But if that's not the case, don't go with the most recent annual report. What about the second choice of multiplying the last quarter's numbers by 4? What's wrong with that? Anybody want to try? Kyle? I can't hear you, Kyle.
Better?
Yeah, I can hear you now.
Sorry, it doesn't take into account seasonal effects. So if there's a company that does really well in the fourth quarter because of the holidays, then it's going to multiply that
You take
across
a
the rest of
retail
the
firm, you take fourth quarter's numbers, you multiply by 4, you're going to overstate everything, right? Don't do that. The third choice and the fourth choice are both accepted. The third choice, you take 4 quarters, you add them up, and which would be, for many of your companies, might be through the third quarter of 2021. It's called trailing 12-month numbers. In fact, many sources give you TTM, trailing 12-month numbers. If you look at the most recent year's column, Capital IQ does it, Yahoo Finance does it. You're creating your own updated numbers. The fourth one is a little dicey because you're trusting somebody's estimates for the fourth quarter numbers. But let's face it, we're deep enough into 2022 that analysts have a pretty good idea what happened in the last quarter. So I'm okay with C or D, but don't take one, especially if it's 2020 numbers, and don't do 2. So we'll talk more about what to do about companies that don't have quarterly statements, because some parts of the world that's not the case, but you want the most updated numbers. Second, today we're going to talk about cash flows. And one of the items you need to compute the cash flows for a company is capital expenditures. Hey, if you remember your accounting, you go to the statement of cash flows, there's a capital expenditure line item. So I'm going to list out some items and you tell me whether this belongs in capital expenditures when you're valuing a firm and computing free cash for the firm. Building a manufacturing plant, capital expenditure? No, obviously, right? That's an easy one. What about R&D expenses? If you define capital expenditure as an expenditure you spend to get growth in the future, I don't see why R&D expenses shouldn't be treated as CapEx. Accountants might not, but that's their problem, not our problem. R&D expenses for a technology firm or a pharmaceutical firm are like manufacturing plants for, or plant and equipment for a manufacturing firm. What about advertising by a company like Coca-Cola? Because remember, some advertising at Coca-Cola is designed to sell stuff now. Some of it is designed to do what? What's a consumer product company's biggest asset sometimes? It's brand name, right? You could argue that some advertising at least is like CapEx. What if you go to work for an investment bank or a consulting firm? What's the biggest asset? Comes in every morning at 7 or 8 and leaves every evening. I don't know what time, but 9, 10, 11 at night. It's human capital, right? Every one of those items, you could argue, is really capital expenditure. I'm laying the foundations for questioning the way accountants actually categorize expenses. Because accounting, as we know, was designed for the old-time manufacturing company. And I don't think accountants have any idea what to do with the big companies of today that tend to be companies that are in technology, pharmaceuticals, companies that accountants like to claim have intangible assets, which is kind of a meaningless term. Because just because they don't know what to do with these expenses, they think the rest of the world is just as at sea. So today we're going to talk about cleaning up for accountants, but almost all of today is going to be spent talking about cash flows. So let's turn to the cash flow page, and I'm going to stop and restart my share. we're going to talk about estimating cash flows. So let me set the table. When we think about estimating cash flows, there are lots of ways you can think about estimating cash flows, but there are three basic steps that I'm going to take you through. This is to just get current year's cash flows. I'm going to start with nailing down earnings. Net income, if I'm looking at equity cash flows or operating income, that's going to be my starting point. Is my earnings number a reasonable number? What did my company make last year? Second, I'm going to look at what the company is reinvesting for future growth in land, building, equipment, R&D, consumer product advertising. Third step, and this I'll take only if I'm trying to compute cash flows equity, I'm going to look at cash in from debt and cash out. Cash, debt repayments and debt issuances. Earnings, reinvestment, debt cash flows. So let me start with the three basic ways in which you can estimate cash flows. So you're sitting down to value a company. Remember, there are two choices. You can get cash flows to equity or cash flows to firm. Let's say cash flows to equity. If you're lazy or you just don't trust cash flow estimates, your estimated cash flows to equity is going to be based on what they actually pay out. What do they pay out in dividends? And if you want to, you can bring in buybacks. So the most direct measure of cash flows to equity is to look at what actually got paid out. But I think I mentioned this. When you do that, though, you're assuming that companies pay out what they can afford to pay out. And that's not true. We know companies don't because they accumulate cash balances. So the second way of estimating cash flows to equity is to look at what cash flows your company could have paid out, potential dividends. And I gave this a fancy name, free cash flow to equity. But free cash flow to equity is the cash left in the till after you've met every conceivable need as a business. Paid for CapEx, paid for working capital, paid off debt. What's left in the till is free cash flow to equity. And I think I mentioned Apple last year had free cash flows to equity of close to $90 billion. That's what they could have paid out. They actually paid out 60 in dividends and buybacks. But that's the difference between actual payout and what they could have paid out. Of course, you could decide to estimate cash flows the entire firm. And to do this, instead of starting with net income, which is what you do for free cash flow to equity, you start with after-tax operating income. Why? Because net income is after interest expenses. You still subtract out what a company reinvests in long-term assets. And the way we usually measure this is the difference between capital expenditures and depreciation. It's called net CapEx. Think of it as what the company puts into land, building, equipment, machinery. If you're a technology firm, what it puts into net R&D. And what it reinvests in short-term assets are measured as the change in non-cash working capital. So those two line items are basically what the company is reinvesting. For free cash flow to equity, I also look at the effect of cash flows to and from debt. When I repay debt, that's cash outflows. When I raise new debt, that's cash inflows. So free cash flow to equity brings into account both reinvestment and debt cash flows, and what's left over is free cash flow to equity. For free cash flow to the firm, I start with after-tax operating income, and I subtract out net capex and change in cash flow, which is reinvestment. I'm not sure whether somebody's playing a
Jack, mute your mic.
in their nose, but if you could mute yourself, I think that would help. So whatever it is, if you could please mute yourself. Now, as you look through past quizzes and you look through my valuations, you might think I have a dozen different ways of estimating free cash flow, but I'm going to kind of crystallize all these ways so you can see what they share in common. The most common way, you look at any valuation textbook, the way we estimate free cash flow to the firm is we start with after-tax operating income and we subtract out net capex and change in non-cash working capital. That's where my book defines it. That's where every valuation book defines it. Gives me free cash for the firm. But I could rewrite this equation. If I define net capex and change in non-cash working capital put together as reinvestment, I can define free cash for the firm as EBIT times 1 minus T minus reinvestment. So when I'm subtracting out reinvestment, I'm subtracting out net capex and change in working capital. I'm just consolidating it. And if I want to look really tricky, here's what I do. I take the reinvestment, I divide by the after-tax operating income. I get what's called a reinvestment rate. I said 30% of my after-tax operating income is getting reinvested. I'm saying exactly the same thing. These equations look like they're three different equations. There's three ways of stating exactly the same facts. But here's where I want to pause first. If you look at all three equations, you know what they share in common? I'm ignoring the tax benefits that come from having interest expenses in all three of those calculations. You know what I mean by tax benefits from interest expenses, right? When you pay interest expenses, you save on taxes. When I do my free cash flow to the firm, I'm acting like those tax benefits don't exist. That's weird. And that's a big saving. So I have a question. It's kind of a generic question that I want you to be ready for, because you'll see this when you first start doing valuation. Why am I ignoring the tax benefits from interest expenses? It's called an unlevered cash flow because of that reason. Why am I ignoring the tax benefits from interest expenses? Kathleen, you want to try?
Is it because they're trying to, I guess, isolate first the value of the firm before accounting for it?
That would mean I have to account for it later, right? And I'm not even doing that. It looks like it's completely slipping through. Go ahead, Aidan.
Wild guess, is it that every company gets that interest expense benefit for
It's
tax?
still a benefit but it depends on how much debt you have, right? I can't ignore it because every company benefits from it. It's still a benefit. Can I give you a clue? What do I discount these free cash flows at? What's the discount rate I use? When you have cash flows to the firm, the discount rate you use is the cost of capital, right? What goes into a cost of capital? A cost of equity. Remember what the other component is? An after-tax cost of debt. You know what I've done, right? I've lowered the discount rate because you get a tax benefit from debt. If I've lowered the discount rate, I cannot now also add it as a cash flow because that would be double counting the same tax benefit. The reason I don't include the interest expenses from tax benefits is they're already in the discount rate through the after-tax cost of debt. And because of that, I'm ignoring it because otherwise I'll be double counting. So when you look at these calculations, remember that they all share a common theme. I'm trying to get to cash flows after reinvestment. Now, whether I define it as net capex and change in working capital, as reinvestment in one line item, or as a reinvestment rate, the end game still remains the same. So I'm going to start with this earnings number, because no matter how you define free cash flow, free cash flow to equity, free cash flow to the firm, I start with a measure of accounting earnings, right? Net income if it's free cash flow to equity, operating income if it's free cash flow to the firm. Stating the obvious might as well state. I'll follow up on that obvious statement. If accountants really screw up earnings, your cash flow is also going to be screwed up. So the first stop you want to make when you build up to cash flows is to take a look at the earnings number to see if it's the number from which you want to build up your cash flows. And there are three things that you consistently should check for. First, make sure the number you're using is the most updated number you can find. In other words, don't take the last annual report number because that's the last annual report you have. You want the most updated. With quarterly data, that's going to be easy. You can treat the 4 quarters, but we'll talk about what to do when you don't have those quarterly reports, but you want the most updated number. So that's the first stop. Second, if you have a commodity or a cyclical company, guess what? Your earnings will go up and down because things happen to your revenues and earnings. You might want to normalize. Fancy word, but you're saying, look, if I'm valuing a hotel company in 2021, I don't want to build off 2020 numbers because strange things happen in 2020. It's just common sense. Sometimes you might take last year's numbers and say, hey, strange things happened last year. I'm going to replace those numbers with something that's more normal. You still have to make some subjective judgments on what normal is, but there's no way around that in valuation. And third, as I said, accountants are not always consistent. There are at least 2 items that accountants have routinely miscategorized for much of the last century. On one of those items, they've finally come to their senses, and the other item, they still haven't. I'll tell you what the 2 items are. The first is lease expenses. When a company signs a lease contract, I'm going to argue that leasing something is the equivalent of borrowing money. Essentially, it's a financing cost, not an operating expense. Until 2019, accountants knew it was a financing cost, but chose to ignore that reality, treat it as an operating expense. We'll talk about the consequences. We'll also talk about what accountants are doing now, because they're doing something that I've done for 30 years to clean up for accountants, because I've never bought into this accounting pitch of, don't worry about it. It's an operating expense. It's a financing expense. The second, as you saw with the other pre-class test, was R&D expenses. If the essence of capital expense is that it's an expense designed to create benefits over many years, not just in the current year, R&D is super CapEx, right? What company does R&D expecting to get a benefit in the current year? So I'm going to take you through the process first of leases and how to convert them to debt, and talk about what accountants are doing and what, whether they're doing it right. And then we're going to talk about how to capitalize R&D and treat it as a capital expense rather than an operating expense. Before I do that, though, let me at least touch on updating earnings. Now, if you have quarterly numbers, the best thing to do is go with trailing 12-month numbers. It's, I think, almost always going to give you a more updated valuation for your company than going with the most recent annual report. But if you don't have quarterly reports, you might have to accept informal numbers. Sometimes I've valued companies with leaks of what revenues will be over a year because they've not updated the numbers. What I'm trying to say is, if it's a choice between a number that comes from an annual report that's old and a number that might not be as clean but comes from a report that's updated, go with the updated number every single time. Just as an aside, even for companies that do quarterly reports, not everything gets updated every quarter. I'll give you an example. One of the things we're going to talk about is employee options and how to deal with them in valuation, because companies give out options to their employees and it drains your equity value. So to value the equity per share in a technology company, you need to know how many options are outstanding, what the strike price is, and when they mature. Every annual report now includes that information, but not every quarterly report does. So if you're valuing a software company, sometimes numbers like revenues and operating income will get updated in the quarterly report, but things like options will not be. Don't get mired in consistency and say, look, since I can't update everything, I'm going to update nothing. I am much more comfortable with you updating the things you can and leaving the things you can't, because essentially the argument you're using is these are the most updated numbers I can get for this particular input. So I'm going to pause right there on the updating question. First, I want to make sure that everybody is on board with why we need updated numbers, because this is an exercise in abstractions. This isn't a case study. This is, do I want to buy the stock today? And guess what? You don't have a choice. Everything is to get updated. Second, the question is, how do we update numbers? The mechanics are fairly simple, but sometimes some companies don't update everything. You got to take what you can. No questions? Okay. So now let's talk about correcting accounting earnings. As I said, there are two items I want to take you through. First is lease commitments, and the second is R&D. Let me first give you my rationale for why lease commitments are really debt. When you go out and borrow money instead of raising equity, why does debt create a different kind of burden on you than equity? What is the, clearly it gives you a tax advantage, but companies are reluctant to borrow money. What is it about debt that makes it different from equity? With equity, you have a residual claim, right? If you do badly, you don't pay dividends, you can't be sued. With debt, you have a contractual claim. What makes debt so burdensome is you contractually agreed to pay X million dollars for the next 10 years, no matter what happens. So the reason we treat debt differently from equity is because of the contractual claim. You say, what's this got to do with leases? Let's say I am the Gap. I go into a mall and I sign a 10-year lease. What does it specify? That I'll pay $1 million to the mall owner every year for the next 10 years, right? Contractual commitment? Absolutely. I've got to make that $1 million payment, whether one person comes in or 100 people came. In fact, in 2020, for 6 months of the year, malls were shut down, but I still had to make the lease payment. To me, I've never understood why accountants even thought that leases were not debt. Leases are clearly contractual commitments. You should be treating them as debt. And that's always been true. Now, to treat leases as debt, it's not rocket science. It's easy to do. This is the other reason I never understood why accountants are so reluctant to deal with this. To convert leases to debt, here's what I need. I need a set of your lease commitments for the next 5, the commitments you've already entered into, your contractual commitments. Next year, 2 years out, 3 years out, show me what your commitments are. Here's what I'm going to do. I'm going to take those commitments and discount them back to today using your pre-tax cost of debt as your discount rate. You know why we use the pre-tax cost of debt? Because those lease commitments are pre-tax commitments. I'm using the pre-tax cost of debt. What I get as a present value is the debt value of lease commitments. I'm going to put that on the balance sheet as debt. However, the balance sheet has this very unpleasant requirement, which is it has to balance, right? So if I put debt leases as debt on the balance sheet, I've got to create an asset. It's called a counter asset of exactly the same amount. Otherwise, the balance sheet won't balance. And once I create an asset, what am I trained to do as an accountant? I've got to amortize it or depreciate it over time. I've opened a Pandora's box here, and I've got to deal with all the consequences. When I capitalize leases as debt, my debt number will change. My depreciation number will change. My operating income number will change. In other words, I'm going to redo all of the income statements. I told you I've been doing this for 30 years whenever I've run into a retail firm or restaurant. So let me take you through the process of how to convert leases to debt. And you're going to see why it matters more in some businesses than others. To understand the types of companies, but this is a big issue. Here's what I did. I took the operating lease expense that companies had last year and divided the revenues last year. Remember, the higher the number, the more leases they have. So you look to the left, these are the sectors which have the biggest lease commitments. At the very top are airlines, because I can't think of a single airline that owns its aircraft. They all lease the aircraft. Huge contractual commitment. Trucking, restaurants, retail. These are the businesses where leases are the way these companies have borrowed money. On the other side are sectors where it's not such a big deal. You're doing an insurance company or an automobile company or a manufacturing company, a financial service company. Leases are not a big deal. So if you've been doing bad things with leases over your entire lifetime, if all you've been valuing are companies like technology companies and auto companies, it's probably not even affected you. But if you've been valuing Walmart or the Gap, this has become a huge issue in valuation. So what I'd like to do is actually take lease commitments and convert them to debt. And as I said, the process is a pretty straightforward one. First, I need your contractual lease commitments for the future. You know what? US companies have been reporting this in their footnotes for the last 40 years. You go to the footnotes of balance sheets, even before accountants came to their senses, is one of the footnotes that say, these are lease commitments in year 1 year, 2 year, 3 year, 4 year, 5, and then give you a lump sum beyond year 5. I'm going to take those lease commitments and I'm going to discount those lease commitments to today using the pre-tax cost of debt. That gives me the value, the debt value of leases. It's going to show up on my balance sheet as debt. I'm going to have an asset that says leased asset. I'm going to restate your operating income because your old operating income is now dysfunctional. You've subtracted out something that shouldn't have. And to do this, I'm going to start with your stated operating income and say, that's not the right operating income. Add back the lease expenses saying I should never have subtracted it out. And then I'm going to subtract out the depreciation you'd have had on that leased asset you created. Sounds complicated, but really it's not a big deal. It's the same process over and over again. It's like actually built into all of my valuation spreadsheets where you say yes to lease commitments, I'll convert your leases to debt. It's the same exact process. I know it's a lot of abstractions here, so let me show how this would work for an actual company. So this is the Gap in 2003. You're all familiar with the Gap. It's a retailer, lots of stores. You know, the Gap has had at one point in time more than 1,000 stores around the country. It did not own a single one of those stores. Every single one of them was leased. So in 2003, the Gap management asked me to come in. And one of my students was up close to the CFO, and he said, can you come in and talk to us about what lease commitments are doing to the company? Because we're hearing that, the IFRS and Gap are already talking in 2003 about converting leases to debt. They said, what will happen to us if leases are treated as debt? I said, okay. So I walked in 2003, and they had, as I said, their contractual commitments for the next 5 years and beyond. So these are not expected lease payments. These are contractual commitments the gap had already entered into. 899 million 1 year from now, 846 million 2 years. So basically that came right out of the footnotes. In the most recent year, the gap actually had operating lease expense of 978 million. So I have lease commitments for the next 5 years. And beyond the 5th year, as I said, they usually give a lump sum. I took that lump sum and spread it out over 2 years. So I have the gap's lease expense in the most recent year and the lease commitments I've entered into for the next 7 years. The pre-tax cost of debt I got for the gap based on its rating, adding the default spread to the risk-free rate, was 6%. So I discount 899 million 1 year at 6%, 846. So basically I'm taking each lease commitment, discounting it back to today. And what I get as a sum of those present values is about 4.4 billion. You're saying, what is that? That's the debt value of leases. And I said, I'm going to show it in the balance sheet as debt. Almost instantaneously, it changes the way I think about the gap, right? I used to think before I did this gap at about 2 billion in debt. Not a big deal, but when you add the lease commitments, its debt has more than tripled. It really owes more than about $6.4 billion. Its operating income, it claimed, was 1.012 billion, but that's not true because they subtracted out the 978 million lease expense they should not have. So I add that back. But this 4.4 billion, which is an asset, I now depreciate, and I don't play any fancy games. It's straight line depreciation over 7 years because that's what my leases last for. And my adjusted operating income is 1.3. So I have more debt outstanding at the gap than I thought and a higher operating income. In fact, there's a shortcut that you can sometimes use if you're in a hurry where you take the stated operating income and add what I call the imputed interest expense. In other words, if this was your debt and your interest rate was 6%, that would have been your interest expense this year. And because it's earnings before interest and taxes, I'm adding that interest expense back. But my suggestion is do it right. Just add back the lease expense, subtract out the depreciation. Now, when I did this for the gap, people said, now what? I have more debt and we have more operating income. Is this good or bad? So I took them through the effect that converting leases to debt would have on their valuation inputs. And they went through various stages of delirium while I did this. Initially, they were very happy about what I was doing. Then they were very, very scared about what I was doing. And I ended up leaving them completely, bemused about what the net effect would be. So I said, let me start with the good news. Okay? So basically, I was telling them, here's what's going to happen when you have to capitalize leases. The good news is, you told me that you made $1 billion in operating income. That's not true. You really made 1.36 billion. They said, this is good. They patted each other on the back. We're more profitable than we thought we were, because I've now added back the lease expense. I said, that's a good news. But I have some bad news. You told me at about 2 billion in debt, but that's not true. You really have about 6.4 billion. That's terrible. We owe a lot more than we thought. So we're more profitable than we thought we were. We have more debt outstanding. Then I said, okay, let me show you what your cost of capital looks like. Before I capitalized debt, remember I had only the conventional debt. They were mostly equity funded. Their cost of capital was 7.31%. I said, if I treat leases as debt, you have a much higher percentage of your capital coming from debt. You end up with a lower cost of capital. At this stage, they were incredibly happy. We're more profitable than we thought we were. We have a lower cost of capital. This is all good, right? I said, let me hit you with the final hammer, and this is not going to be good news. One of the key drivers in the value attached to a company is what kind of returns it makes on its projects. Return on invested capital, return on equity. When you think about how we compute that, this is one of the few places, we'll come back and revisit these numbers where we use book value numbers for invested capital and book equity. Before I capitalized leases, I thought the gap was making about 12.9% return on capital because I was counting only the traditional debt. Once I capitalized leases, that return on capital drops from 12.9 to 9.3% because even though I'm more profitable, my base is now much bigger. I brought debt in. So let me summarize. If I capitalize leases, the gap becomes more profitable. It has more debt. It has a lower cost of capital and a lower return on capital. So they all look at each other and say, what does this all mean? Do we become more valuable?
他爸有一天说今天不会再教死堂课，我想一想，今天网课啊，傻逼啊！
Guys,
去收耳走。
Max, you need to mute yourself. There you go. Okay. So he says, what does this all mean? There's actually a shortcut you can use to decide whether capitalizing leases will make your company more valuable or less valuable. One of the drivers of value is the spread you earn between your return on capital and the cost of capital. Let me repeat that again. If your cost of capital is 7%, you want to make as much above that as possible to be a valuable company. Before I capitalized leases, here's the spread I had between return on capital and cost of capital. I thought they were earning 12.9%. The cost of capital was 7.3%. I thought they were making a 5.59% spread on the capital. After I capitalized leases, both the return on capital and cost of capital go down, but the spread I have is now down to 3.05%. That's not good news. The reason we capitalize leases is to get a better sense of what is my company actually making on its projects. Because I need to compare that to the cost of capital, and I'm getting a more realistic judgment when I capitalize leases. This has always been the argument for why leases need to be capitalized. Because until they were capitalized, we were overstating the returns on equity and returns on capital at retail firms and restaurants, and this brings them back down to earth. I'll give you one example of a company where my view on the company changed when I capitalized leases. It's Starbucks. I mean, think about it. You walk out in New York, there's a Starbucks pretty much in every other block, right? Starbucks everywhere. And in some of the most expensive locations in the city, there's a Starbucks on Bryant Park, right across from Bank of America, that corner. They're all leased. They're all in big cities and urban areas, and you're paying huge amounts of lease commitments. But people are okay with it. But their argument was, but Starbucks is a good company. It earns a return on capital well above its cost of capital. But that was true only if you did not capitalize leases. I remember about 7 years ago, I capitalized lease at Starbucks, and overnight it went from being a company that earned above its cost of capital to one that was actually earning a little less than its cost of capital. You know how deadly that is when you're growing as fast as Starbucks and every store you're opening is actually earning less than the cost of capital? This is a pathway to value destruction. It took about 3 years for Starbucks to notice that they were opening stores that they should not be opening. 3 years, but they kept opening stores. In fact, they were in serious trouble. They had to come in and close a few hundred stores just because they're over. I think they're again hitting another point. And part of the reason for that is consistently miscategorizing leases can lead to very bad investment decisions. So the argument for capitalizing leases is not an abstraction to get a better sense of how levered a company is, to get a better sense of what kind of returns it's making on its projects, because without it, really can't value companies. As I said, this argument to me has always been a slam dunk. There's no really counter argument to it. And you know what? Accountants have known it. You know how long they've known it? I actually was able to find a printed brochure from 1949. Hold on to that year, 1949, that the accounting department at NYU, there was no Stern then, but whatever the NYU Business School was called, the accounting group had created a conference. You know what the title of the conference was? Why Leases Should Be Treated as Debt, 1949. You know when accountants finally fixed it? 2019, 70 years later. What's the lesson you get from this? Don't wait for accountants to do the right thing, because you could be waiting 70 years for it to be done right. In 2019, IFRS and GAAP both decided that companies should treat leases as debt. This is good news for you, because it means that when you open up the balance sheet for a US company or a European company, you're going to see leases show up as debt on the balance sheet, as it always should have. Pre-2019, you would have had to do it yourself. But as you can see, this is not difficult to do. That's why I've been doing it for 30 years. Every measure I've reported on my website has capitalized leases. So when you see the return on capital I report for retailers going back to 1999, those margins and those returns on capital are based on capitalizing leases. So now everything's okay, right? Well, I don't trust accountants. So one of the things I've been doing for the last 3 years is, while accountants have been capitalizing debt, I'm still doing, because they still give me the raw data to do the capitalization myself. I've been capitalizing leases as well to see how close my numbers are to accounting numbers. In the US, I'm actually pretty close. My estimate of leases treated as debt is 1.15 trillion. According to the accountants, it's 950 billion. Close enough, I can live with that. Accountants give a little more leeway to companies. If you have a lot of flexibility built into your leases, they allow you to treat it less like that, which I'm okay with. If you look at Europe, the difference is much bigger. But if you look at emerging markets, the chasm is wide. And here's why. Not all emerging markets follow IFRS and GAAP. So there are lots of emerging markets where leases are not treated as debt. So if you're in looking at an emerging market company, check, because it's very possible leases are not treated as debt. And in many emerging markets, companies are taking advantage of the loopholes, because when accountants write rules, guess what companies do? They look at the rules and they look for loopholes. I'll give you an example. A lot of Indian companies were asked to capitalize leases and treat them as debt. But then the accountant said, if you have escape hatches put into your lease contracts, if they're renewable after 3 years without penalty, or 2 years, you don't have to treat the entire lease commitments as debt. So if you're a company with a 9-year commitment, you can put in renewable contracts at the end of year 3 and end of year 6. We count only the first 3 years. Well, the current Indian firms have taken advantage of that loophole. They've gone in and rewritten their lease contracts to have an escape clause after the 3rd year. This is why I don't want accountants sometimes to do the right thing, because they find a way to screw it all up. And if you're not careful, you're using a number you shouldn't be using because you're trusting the accounting categorization. So in all my spreadsheets, I've left that, do you want me to convert leases to debt option? If you don't trust the accountants, don't count the lease debt from the balance sheet. Say yes to my question and then enter the raw data, which is still in every company's annual report, and I will capitalize leases for you. But the end game is still, I want to get leases onto the balance sheet as debt, because that's the only way I get a better sense of what companies are actually borrowing. Any questions on treating leases as debt? Go ahead, Aid.
I have 3, but I'll start with the first. If there's any, there's a question that there's a point that said spread with respect to the estimation of GAP's cost of equity, I think.
No, I haven't talked to, there's no cost of equity in this story at all. There's only cost of debt, a pre-tax cost of debt,
So,
right? 6%.
So
Cost of equity doesn't enter the equation. So it's cost of debt. That's a pre-tax cost of debt. To get to that, I said, you start with the risk-free rate and add a default spread, just like we did last class to get a cost of debt.
Okay, so when you said spread, it was a spread of 3%. That's what you meant when you said spread. Like
Yeah.
now, okay.
Based on a rating or based on synthetic rating. Remember how there are multiple ways. So it's that spread that comes from that.
Okay. Second one is, what were in slide 133, what were accountants doing wrong, and what explains the difference?
It's not that they're wrong. Accounting, when they wrote the rules for leases, allowed some escape clauses. I count all lease commitments as debt. I don't allow companies any escape clauses. But the accounting rules actually allow companies to not count something as debt if they have escape clauses or something in the lease agreement that makes it more flexible, which I don't have a problem with. But the problem I have is the game playing that comes about because you've written these rules. So I count all commitments as debt, and I don't allow for any excuses. Accountants do allow for some excuses, which is part of the reason, even in the US, our numbers are not. My numbers will always be higher. Why? Because I count everything. They don't count everything if there's an escape hatch.
Yeah, and these some excuses may account for a major difference in the emerging.
That's the main difference in the US. In the emerging markets, the difference is much more fundamental. It's because many emerging markets are not covered by IFRS and GAAP, so they're not even capitalizing debt. So if you're looking at an Indonesian company, don't assume that debt is going to show up in the balance sheet, because Indonesian companies don't follow IFRS. So that's why with emerging market companies, you need to check the balance sheet to see if leases are convert debt. If they're not, you got to do it from scratch yourself.
Okay.
Yeah. Any other questions? Okay. Now, what is it about leases that made them like that? It's the fact that they're contractual commitments. You got to make it good times and bad times, right? Can you think of any other examples of things that are like leases that should be treated as debt. Let me give you throwing an example at you. Netflix. Is there something like leases that you might worry about?
Rights to the shows.
In fact, if you open up Netflix, a big chunk of the shows are original content, right? Things they make, but a big chunk are rented content. Now, I don't know, is it for the longest time, you know what the most watched show on Netflix was, right? It was Friends for about 5 years. No, and the way they got the rights to Friends is they went to NBC and they signed a 5-year contract where they said, we'll pay you $100 million a year and you give us the content that we can show. So if you look at Netflix financial statements, when they had those footnotes for lease commitments, they also had a column that says content commitments. You're saying, what the heck is that? Those are the contractual commitments that Netflix has entered into for content on movies and TV shows that they've signed in. So when you value Netflix, you know what I'm saying, right? Take those content commitments, convert them to debt. Netflix is a lot more debt than you think if you count those content commitments. And that's got to be built into the cost of capital, just like you would debt. Here's another example. I'm a Yankee fan. And I still remember in 2009, when they built the new Yankee Stadium, they opened it, I decided to take my two oldest boys. Actually, I gave everybody, I had 4 kids, and I gave everybody the option of going to the game. And my 3 boys all jumped on, and my daughter I'd have taken, but she then asked me a question which led me to Banner. She said, will there be Dippin' Dots? Have you ever been to Yankee Stadium? Dippin' Dots. I said, I'm not taking you to opening day on Yankee Stadium and spending half the game looking for Dippin' Dots. If that's why you're coming to the game, I'll buy you Dippin' Dots at home. You sit and watch it on TV. So there's nothing sexist about it. I took my 3 sons opening day, Yankee Stadium. So imagine, we got seats in the bleachers. I bought it on, StubHub or something. We're sitting there. We watched the Yankees run onto the field. And all I could think of was debt and equity. You're saying, that is really sick. You're sitting in Yankee Stadium. You're thinking, here's what I saw. I saw a guy called Mark Teixeira run to first base. And what I saw was $15 million every year for the next 6 years. So guys, Robinson Cano ran to second base. He was my cheap guy at that time, $9 million for the next 3 years. At shortstop was a guy called Derek Jeter. At that time, $23 million for 4 years. And then on third base, the person was supposed to be there would have been my biggest debt. You know who was supposed to be there? A guy called A-Rod, who'd just been signed to a 10-year, $275 million contract. You see where I'm going? Each of these is a contractual commitment. If you're valuing the Yankees, I'm going to take the present value of those commitments and treat them as debt. I'm not saying you're a bad company or a good company, but these sports teams, and if you don't like baseball, if you're a Barcelona fan or you're a Manchester United fan, I don't know what's Manchester United paying Ronaldo. I don't know. 30 million a year for the next 6 years, 50 million. These are all contractual commitments. Sports franchises are already very highly levered because their contracts, there's almost no escape clause. I remember the time Jason Giambi was a Yankee, he was hitting like 150. He was playing terribly on the field. They tried to send him down to the minors to get his batting, swing back. He refused to go down. You know what? They had to continue to pay him $26 million a year while he sat on the bench. So when you think about leases, it's not just leases. It's basically any contractual commitment you've entered into is essentially the equivalent of debt. So everybody agree with my logic on leases and what I'm trying to do here, convert leases to debt and why I'm doing it? Okay, so let's move on to R&D. Again, when you think about R&D, it's not the same in every business, right? There are some businesses which are very big spenders in R&D, and I've listed some of them, pharmaceuticals, technology, and some businesses which spend almost nothing on R&D. So again, if you think about looking at R&D and doing it right, it's going to make a much bigger difference if you're valuing a pharmaceutical company or a technology company than if you're valuing a manufacturing company. I know many of you are valuing technology companies. Some of you are valuing pharmaceutical companies. So this part of the discussion is critical because I'm going to change the way you look at their financial statements. Again, let me start with the logic here. I still remember my first accounting class. My accounting professor said, if you have an expense that's designed to create benefits over many years, it's a capital expense: land, building, equipment, machinery. But if you use that definition of benefits over many years, R&D is clearly a capital expense. And I've never understood why accountants insist on treating it as an operating expense. Actually, let me take that back. I understand why they do it. It just doesn't make sense. I still remember about 10 years ago, I was invited to give the keynote at the AICPA conference. You know what the AICPA is? It's basically every CPA in the country. And the conference was in Vegas. And it's kind of ironic that you're an accounting conference but Vegas is the biggest ballroom. So there are 1,000 accountants in the room. And I gave a keynote, and I don't think they're going to invite me back again. Part of the reason was the title. I said, 10 things accountants do that I don't quite get. And I went through a list of things. And one of the things I listed was, why do you guys keep expensing R&D? The logic seems to be that R&D should be capitalized. And you bring this up with 1,000 accountants, they came up with reasons, right? What do you think the most common reason accountants give for expensing R&D rather than capitalizing it? Think like an accountant. The reason is going to come to you. What is it about R&D that leads them to expense it rather than capitalize it? Anybody? Go ahead.
It's not often fruitful that you'll find something really.
They said it's too uncertain. That's exactly what they said is the main reason. They said it's too uncertain. The benefits might not be there. I said, okay. If I built a factory in Kazakhstan, would you let me expense it? No. Who knows what can happen to it next year? Uncertainty is not a dividing line you use on any other capital expense. Why do you bring it up just with R&D? It makes absolutely no sense. They said the second fallback they had was, we're just trying to be conservative. Do you see why it's conservative? They said, if I expense R&D, I'm going to report lower income, and lower income is conservative. So what's wrong with that? And I said, okay, your income is lower, but when you expense something, you know what you show on the balance sheet? Absolutely nothing. You've taken your biggest assets off the balance sheet. So when I compute the return on equity or return on invested capital for a technology firm, I get this huge number, even if it's not a great company, because you've not shown its biggest asset on the books. So let me cut to the chase. There is no good reason for doing what accountants are doing to R&D. You're saying, why don't they fix it? Remember, it took them 70 years to fix leases. Maybe in the year 2079, or 2179, or 2279, they'll come to their senses, but I can't wait for them to do it. So I'm going to do it for them. And here's what I need to do to capitalize R&D. Let's say you're a company, you do a lot of R&D. I'm going to start with the question. I'm going to say, on average, how long does it take between the time you do R&D and a benefit emerges? Notice how I threw the on average up front, because I know some of your R&D will not pay off. Some might pay off in 3 years, some in 7, just give me an average, 5 years. Here's what I'm going to do. I'm going to go back and collect your R&D expenses every year for the last 5 years. You say, why are you going back in time? Because if I decide to capitalize R&D, I've got to do it from the beginning of time. Because what does capitalizing mean? Rather than take the entire expense in 1 year, if you tell me it takes 5 years, I'm going to write off 1/5 each year, right? Because that would be the logical thing to do. So every year's expense, I'm going to spread out over time. I'm going to keep track of two numbers. How much am I writing off or amortizing this year? And how much of that expense from previous years is still left over? I know it sounds incredibly abstract. So let me give you an example. You've heard of a company called SAP. It's a German software company. It's actually, it competes with Oracle and Salesforce for business software. It's a B2B company. It's a technology company, invests a lot in R&D. So when I valued this a few years ago, 15 years ago, probably, I gave the R&D a 5-year life. You're saying, how do you come up with the life? I'll be upfront with you. I use 3, 5, or 10 for most companies. 10 if it's a pharmaceutical company in the US, because you got to go through the FDA approval process. It takes a long time. 5 if you're a company that does R&D that takes a long time to pay off because you got to check things. But with companies which are software companies, you're probably looking at 2 to 3 years. 3, 5, or 10, I went with 5 for SAP. And remember what I said I was going to do. I was going to collect the R&D expenses every year for the last 5 years. So there's the most recent year's expense. And because the most recent year in discounted cash flow valuation ended yesterday, that's like spending the money yesterday. So nothing is done to it. But the R&D expenses from the previous 5 years, here's what I do each year. I take the R&D expense from 5 years ago, 745 million. I write off the last 1/5 of it. Remember, I've been writing it off every year. The last 1/5, it's off the books. R&D expense from 4 years ago, I write off 1/5, there's 1/5 left over. R&D expense from 3 years ago, I write off 1/5, there's 2/5 left over. So I keep track of what I'm writing off, which is always 1/5 of the expense, and what's left, which is going to go from nothing to 1/5 to 2/5 to 3/5. And I add up those numbers. If you add up the last column, you come up with about 903 million. So basically the last column. What is that? That would be the amortization I would show in my income statement this year if R&D had been capitalized all the way through. If I add up the second to last column, I come up with 2.9 billion. You're saying, what is that? That's going to show up on my balance sheet as capital invested in R&D. It's going to show up as an asset. And because my asset side is now higher by 2.9 billion, I've got to raise something on the liability side. So I'm going to raise shareholders' equity by 2.9 billion. So here's the net effect. I'm going to show a much higher book equity because of the 2.9 billion. I'm going to show amortization. And here's the final adjustment. To get my operating income this year, I'm going to clean up what the accountants tell me the operating income is. I'm going to add back this year's R&D expense, 1,020, and subtract out the amortization. So my operating income is going to increase by 117 million. Again, lots of different things happening. So let me bring them all into one page. In the case of SAP, and this is going to be true for most technology companies and pharmaceutical companies, here's what you're going to see happen. When you capitalize R&D, your operating income is going to increase. Why? Because you're adding back the R&D expense and subtracting out the amortization. But that increase is going to get smaller and smaller as the company matures and the expenses start to level up. My balance sheet, my book equity is going to increase because R&D is now going to go into my assets and push up my book equity. So my operating income is going to be higher. My book equity is going to be higher. And when I talk about capital expenditures of this company, R&D is now going to become part of my capital expenditure. I'm being consistent. In fact, if you look at the free cash flows of the firm from capitalizing R&D, the free cash flow of the firm doesn't change when I capitalize R&D. All that changes is what operating income I start with and what I see as reinvesting. But knowing that is critical to valuation, right? I mean, if you're valuing a technology company and you're just focused on the bottom line, you know how I can fool you? I can make my earnings jump as a technology company or a pharmaceutical company by just cutting my R&D to the bone. When you cut R&D, you have lower expenses, your income pops up, you reward me with a higher stock price, but I'm cutting out my future, right? Because I'm not spending the money on R&D. So when people say, why are you doing this? What's the point of doing this? One reason I'm doing this is I want to get a sense of what you're reinvesting for the future. What are you setting aside? So even though my cash flows might look the same, a company that gets the same cash flow with a big R&D, I'm going to reward with a higher growth rate than an otherwise similar company with the same cash flow with a much smaller R&D. Again, it's to get a better sense of what my company is actually doing. So again, let's look at why we treat R&D as a capital expense. It's because you get benefits over many years, right? And already you can see this is not just for R&D. I gave you the example of a consumer product company like Coca-Cola. Your biggest asset is your brand name. Some of your advertising expenses are really designed to build a brand name. It's got nothing to do with selling more this year. You could argue that you should be capitalizing those expenses and treating them like we do R&D. 3 years ago, when Uber went public, I faced a challenge. What's Uber's biggest calling card? What was it that they offered? as they, look how great we are as a company, how many riders they had, right? In fact, a lot of companies which are subscriber-based, customer-based, rider-based, that's what they go to. Look at how many users, how many subscribers. Uber has very little in traditional CapEx. They don't own the cars. They don't have plant and equipment. You know what their biggest CapEx is? What's Uber's biggest CapEx? If their biggest asset is riders, that's what they're bringing to the game, the biggest CapEx is what they're spending acquiring these riders, customer acquisition costs, subscriber acquisition costs. One of the things I tracked, one reason I'm so down on Netflix, is their cost of acquiring an additional subscriber has doubled over the last 5 years. That's news, right? That's important information when you're valuing Netflix. If it's costing you twice, why is it doubled? Because the market is saturated. The US market, they pretty much hit everybody who's going to buy Netflix already. You're saying, but they've only 70 million subscriptions. That's because 4 people can be on the same Netflix subscription. There are 5 people on my Netflix subscription. All 5 of us, I pay the higher fee because 4 of us can then watch at the same time. But that's important information. How much does it cost you to acquire a subscriber or user is critical to valuing these companies. And to do that, we have to treat these costs as essentially the equivalent of CapEx. The rule book in accounting was written 100 years ago for manufacturing companies. It doesn't work with these companies. We're just redefining accounting using its own principles, saying, this is what you should be doing. And it's not because we want them to do it, because it'll take them a long time to do this right. It's because we can do it ourselves. Any questions on why we capitalize R&D, what it does to the numbers, and how it plays out in things like R&D? I'll give you one final example of something like R&D at oil companies. Maybe you can guess. What is the analogous expense to R&D at an oil company that right now accountants are screwing up on? You heard of exploration costs? It's what oil companies spend looking for reserves. Exploration costs are just like R&D. It's a tip of the iceberg we're looking at here. So let me move to the third item. You've updated, you've cleaned up. Saying, what if I have a loss? So let's say you're valuing a company that's reporting a loss of $500 million. But the reason it has that loss is because it had a big one-time charge of $1 billion. It's truly a one-time charge. I'll give you an example. About 7 years ago, Boeing reported a loss because of a strike in the middle of the year. And when Boeing has strikes, they're very expensive because all their assembly lines have to be shut down and it takes a lot of money to open them up again. If it's truly a one-time loss and you're valuing this company, you know what you should do? Act as if that expense is not there and their true profit is then what? If the $1 billion expense is truly one time, it's not going to come back. Remember, it's all about forecasting the future. You should be forecasting based on the $500 million loss. You should be basing it on a profit of $500 million. See how I got from a loss to a profit? I just acted like the $1 billion was not there. This seems like an easy way out, right? You have a company, a lot of extraordinary items, just take them out, look at. For some of your companies, your loss-making company will become a money-making company and you do it. But I'll add a caveat. Let's say you look at your company over time and you notice that every 5 years, this company reports a one-time loss of $1 billion. You should get suspicious. Because here's what I see then. This company doesn't have a one-time loss. Basically, what it's doing is taking something that really cost them $200 million a year, and every 5 years saying, oh, look what, it's extraordinary. Because when you call something extraordinary, analysts ignore it, investors act like it's not there, but you're just playing games. I remember when I was valuing Xerox, when it was actually a company, now it's just a shell. And I was looking at their income statements every year for 10 years, and every year, that a one-time charge for 10 years in a row. At which point he said, this isn't a one-time charge, this is a 10-time charge. Stop playing games here, because if it shows up every year, it is really not an extraordinary item. So look at your company over time, and something is extraordinary, look back and see if it's shown up only in 1 year. In which case you're fine, just ignore it. But if it's showing up every third year or fifth year, then it's really not extraordinary. It's just lumped up and shown in 1 year. As I said, every cash flow number starts with an accounting number. The accounting number is screwed up. The cash flow number is going to be screwed up. I'll tell you in hindsight, when you value companies, the companies you're going to get most wrong are companies where it's not that the accountants have made judgments on CapEx and OpEx, because you can see, you can reverse those. It's when the accountants are lying, when there's fraud. And every 10 or 15 years, we go through a scandal, everybody wakes up, there's accounting fraud, we've got to do something about it, then they forget about it over the next 10 years, and the whole cycle repeats. But one of the biggest fraud cycles in the US happened between 1998 and 2002. Lots of companies committed accounting fraud, and a new branch of accounting was born called forensic accounting. You know what forensic accountants do? They go through annual reports looking for clues that will tell them whether there's fraud going on. I'll give you a few examples. Now, this is only I'm going to touch on the surface here. You know how in your income statement, you have a measure of income, right? That's called accrual income. In your cash flow statement, you can come up with an income, which is cash income, which is net income, change in working capital, etc. And for companies, accrual income and cash income are almost never the same. Some years accrual income will be higher, some years cash income will be higher. But if you see a company where accrual income runs consistently above cash income, you should get suspicious. Something is going on in the company where, that shouldn't happen. So those are the kinds of clues you're looking for. Tax rates, effective tax rates that go from minus 11% to plus 37% to minus 6%. I'm not saying it's definitive proof of fraud, but it's something that should be a red flag. So if any of you are interested in forensic accounting, I'll send you a couple of links on readable forensic accounting. Most of them are almost unreadable. They're just written by accountants, I don't know for whom. But there are some readable versions of forensic accounting. I'm not suggesting any of your companies has committed fraud, but take a look at some of the flags they suggest you should look for, because you want to catch these companies before they announce the fraud, because after they've announced the fraud, it's too late. There's nothing you can do. You've already overpaid for these companies. Which brings me to that special subset of companies that some of you are doing, which is the money-losing company. I don't know which one of you is the unlucky one in your group. It's got the money-losing company, because you have a much bigger challenge than the people valuing money-making companies. So you're saying, what do I do with a money-losing company? Start with the question. Why is my company losing money? It sounds like a stupid question, right? Because the answer is because their expenses are higher than their revenues. I know that's a technical reason, but there are fundamental reasons why your company could be losing money. And I'll give you some of the choices. It could be losing money because it had a temporary problem, something that happened during the course of the year. During 2020, every company had this excuse, right? It was COVID. Our hotels were shut down. It could be because of cyclicality. You're an automobile company, the economy has gone into a recession. It could be that you're a young company. Remember, young companies lose money, not because it's a problem, but because it's a feature. You're building up a business model. It could be that you have some structural issues within your company that need to be fixed. You have assembly plants that are too expensive, or it could be that you just have too much debt. Start by diagnosing why your company is losing money, because the way you deal with the losses will be different depending on the reason. If it's a temporary problem, your life got really simple. Like that one-time charge, just take the expense out, look at what your income would have been without that problem, and build your valuation. So it's gone, it's behind you. If it's cyclicality, then you might want to normalize. Look at what your company made during a recovery year, a recession year. Same thing for commodity companies, right? Prices go up and down. So if I'm valuing an oil company in 2021, 2020 might have looked terrible for them because oil prices were down, but I could average across time. If your company is a young company losing money, don't fix it by making its margins positive next year. That's not going to happen. There you got to map out a pathway to get what I call a target margin. This is something that you see in every one of my valuation spreadsheets. Tell me what you'll make after you've gone through the pain of growth. So that might not happen till you're 5 or 6 or 7, but you're mapping out a way of getting there. If your company's problem is leverage, just has too much debt, then you might have to map out a way in which the debt ratio comes down over time. You have to have enough cash flows to do it. But remember, in your cost of capital, that debt ratio you have over time can reflect what you think this company would do. And finally, we have a company which has some long-term issues that need to be fixed. Its assembly plants are old and inefficient. It's kind of difficult. Again, you can't fix this overnight. You've got to ask the question, what are the chances that I can fix this? And second, what will the margins look like if I can fix this problem? So depending on why you're losing money, the kind of pathway you use to get to that end value is going to be very different. I know we're getting to the end of the class, a couple of final points to make. Now, one of the things that I haven't talked about is remember that operating income has to be multiplied by 1 minus the tax rate to come up with an after-tax operating income. We ran into this problem earlier when we did cost of debt in the last class. And there, if you remember, I said always use the marginal tax rate. Does anybody remember the reason for that? Why do we use the marginal tax rate when we do cost of debt? Because interest saves you taxes on your last dollar. We're going to run into the same question here because here I'm multiplying the entire operating income by 1 minus the tax rate. And here are your choices. You can use the effective tax rate. You can use the marginal tax rate. You might use a weighted average marginal tax rate if you're in multiple countries. You could use a cash tax rate based on what taxes you actually pay. Or maybe the answer is none of the above, but then you got to fill in what you'd use instead. But this would be nice if it were true. Maybe I can get away with using any of these tax rates as long as I'm consistent and use the same tax rate. I'll tell you which answer will not apply. You can't do F, because if that were the case, you know what you would use as a tax rate in every company, right? If all you have to do is be consistent, what's the easiest tax rate to work with? 0%. Act like every company is tax-free. So it's not F. The question is, what tax rate should I use? Now, and I'll set the table for this because if you look at effective and marginal tax rates, I report effective tax rates by industry group on my website. Take a look at the tax rates and compare them to the marginal tax rate in the US. The marginal tax rate in the US is 21% plus state and local tax, about 25 to 27%. There are very few industry groups, the effective tax rate is higher or close to the marginal tax rate. Most of the industry groups, it's lower. So I have a question. How come companies have effective tax rates that are lower than the marginal tax rate? I thought the tax rate was on corporate income. It's not bracket creep, right? Because for individuals, the reason your effective tax rate is lower than your marginal tax rate is as you make more income, your tax rates climb. US companies get to the highest marginal tax rate at 3 million. So it can't be the reason for the difference. So what are some of the reasons effective tax rates are lower than the marginal tax rate? Aidan?
Does it have something to do with the income that's tax exempt?
One is it's not even tax exempt. You have deductions that might allow you credits that you might use. So one is you're taking advantage of legal components in the tax law. You know, the most common reason though for US companies is if you have income outside the US, remember it's taxed at a very different marginal tax rate. Hong Kong, the marginal tax rate is 15%. In Brazil, the marginal tax rate is 34%. If you make a lot of income in lower tax locales, your weighted average tax rate, the reason Apple's tax rate is 16% is not because they're cheating. It's because they make a lot of income outside the US. And with technology companies, there's this added layer of ambiguity of what exactly is selling and where. You know, for a long time, Google actually put YouTube in Ireland. They claim that because when you're doing stuff online, what does it matter where physically you're located? You know why they put it in Ireland? Because that the advertising revenues YouTube collected, they could claim were Irish revenues. The advantage of having Irish revenues, you have 12.5% tax rates. So this is one of the things that governments are grappling with is to kind of get companies to pay more in taxes. You got to nail down these intangible products that get sold online and say those came from the US, not from Ireland. It's very difficult to do. I'm not saying there's an easy fix. But the biggest reason why effective tax rates are lower than the marginal tax rate is because of either tax deductions and credits. In other words, you're deferring taxes, or because you have a lot of international sales. If it's the first, it can't last forever. You can't defer taxes forever. You see where I'm going? When you do your valuation, I'm okay with using an effective tax rate of 15% for year 1, year 2, year 3. Your reasoning being I have really good tax laws, I'm going to defer taxes. But there is a point in evaluation where you can no longer use that excuse, right? When you get to your terminal value, what happens after that? It's forever. If you leave your effective tax rate at 15% and the marginal tax rate is 25%, you have a problem. You're deferring taxes forever. And if you believe you can pull it off, there's a padded cell in a federal penitentiary waiting for you. You can't do it. So here's my suggestion. Start with the effective tax rate, but over time, move towards your marginal tax rate. If you're a money-losing company, you might pay no taxes right now. In fact, you might not pay taxes even after you start to make money. And this is going to be my last page. And let's see why. Let's assume that you have lost money historically. You have $1 billion in NOLs, because in the US, when you lose money, you're allowed to carry it forward. And let's say I expect you to make $500 million every year for the next 3 years. If I'm valuing a company, how much are you going to pay taxes in year 1 and 2? You got $1 billion NOL. So in year 1, you're going to pay nothing in taxes. Use up $500 million. Year 2, you're going to pay nothing in taxes. In year 3, you might pay a 40% tax rate or 30% tax rate. So for money-losing companies, this becomes a challenge. You got to keep track of how much money you're losing and use those NOLs to offset your taxes when you start to make money. Don't worry, my spreadsheet does that for you, but I want you to see what I'm doing when I keep track of your NOLs is I want to give you the credit of those accumulated losses when you first start to make money. So I'm going to stop there because we've covered a lot of stuff. If you get a chance, do the weekly challenge for this week. It's good preparation for the quiz. So think of it as more quiz work, because in addition to the practice quizzes, so do the weekly challenge, because it's actually the weekly challenge from last week that I put up last Wednesday about adjusting earnings for leases and R&D. So give it a shot, because it'll give you a sense of the challenges you might face in converting leases and R&D from operating expenses to financial and capital expenses. That's about it. So I will see you on Monday. I will stay on after I stop sharing for a few minutes, or at least 10 or 15 minutes, if any of you have questions about your project or about the quiz or whatever else. But